Good evening, Canada. Welcome back to the Investor's Guide to Thriving. It's November 19th, and we've got lots of big news since last week's episode. Elon Musk's personal brand has literally gone beyond stratospheric as Tesla flirts with all-time highs. And it seems many a vaccine that was having trouble in trials just before the US election are now showing super high efficacy rates. So does all of this mean that 2021 will see a return to normal and a roaring economy? Or will this glimmer of hope end up taking longer to get the world back in motion? As usual, Larry will have some thoughts for you tonight on what the big headlines could mean for the markets and the economy. And we'll be with you for two more webinars after tonight, November 26th and December 3rd at 7 p.m. Eastern Time. Of course, you can always catch Larry on BNN's BERMAN'S Call, Monday at 11 a.m. Eastern, or online at bermanscall.com. We hope you can make time to help Larry and I support childhood leukemia research at Sick Kids and Alzheimer's and dementia research at the Baycrest Foundation. We put these webinars on at no cost, and the reason that we do that, as opposed to charging something for admission, is because we really do appreciate the support from our audiences for these causes. We believe they're very, very important. Larry and I have both had close personal family experiences where we've realized just what an impact these great Canadian institutions have on making people's lives better. If you'd like to make a donation, please use the links in the survey that you'll receive after the event. This is how we're able to track and match your donations, and we really do appreciate the support from those of you who have already done so. That survey I mentioned is also your gateway to access the webinar replay. It will arrive in your email tomorrow morning. Let us know how we did, and you'll get a link to access all of the above and submit questions for the next webinar. Well, as always, we are thrilled to bring you the Investor's Guide to Thriving, and in large part, that's thanks to the support of our excellent partners, and that includes National Bank Direct Brokerage. They not only support this series, but also Larry's Investor 101 videos on YouTube. These are great for first-time investors, new investors. They're great to send to family members who are just looking to get into investing, so you don't have to explain the basics to them. You can do it with technology. But you can also sign up for Larry's YouTube channel if you hit the subscribe button, hit the little bell icon next to it, and then every time Larry posts one of his weekly market update, they're really cool 2-minute hits where he tells you what he sees going on that week. Anything on YouTube from Larry, you'll get a notification on your phone. So there's no question, 2020, markets have been moving and shaking. Lots of emerging themes as our economy reshapes around what the new normal is going to be. And investors are looking to maximize their exposure to some of those themes. That often raises questions around the appropriate use of margin and credit. And so here is Ann Lee from National Bank Direct Brokerage to explain how self-directed investors can access these tools.
Thank you, Jared, for the introduction. And I was wondering what clever intro you were going to make now that the election is over, but of course you never fail to disappoint.
Yeah, it's never over. There's always the next one coming, right? Thanks, Ann.
For sure. So my name is Ann, and I am one of the business development managers at National Bank Direct Brokerage. And we've been around for over 30 years now, here to always encourage clients to play an active role in managing their own investing. So again, we're very happy to join this season in support of all the work Larry has done for all of those wonderful foundations. So typical disclaimer, I'm here to remind you all not to take anything that I say as actual advice or recommendations. It is self-directed after all, which means it is expected to do your own research and due diligence. And for tonight's topic, I will be going over the basics of trading in a margin account and how you could potentially use this strategy to your advantage. So if you recall the last time you opened up a non-registered account, you probably came across two options, whether to open up a cash account or a margin account. And cash accounts are simple. You have to have the cash available for all purchases and theoretically not a penny less. However, with the margin account, you are allowed to borrow against the market value of your investments. And here to highlight one of the advantages of a margin account, it is that you are able to borrow against it. So a line of credit and a margin account do bear some similarities, but also have some key differences. So for a line of credit, the amount is predetermined. And on the previous slide, you'll see that for line of credit, you have to put in an application at your bank. And the underwriter will look at a couple things like your credit, your income, etc., in order to determine whether you are to borrow the $50,000, let's say. Now, the amount that you end up borrowing out of that 50,000 will also reflect on your credit bureau. On the other hand, with a margin account, the amount you can borrow is based on the market value of eligible securities that you can hold in your margin account. So there is a credit check when applying for a margin account at first, but keep in mind that the amount that you end up borrowing does not reflect on your credit bureau, which is pretty interesting, and I'm sure there are ways you can use this whole concept to your advantage. Now, I'll show you the calculation behind the margin required, and it's easier than it sounds. So your margin required is the total loan value of your securities, also known as the broker advance, plus the investment that you made. Now you might be wondering what investments are eligible to be borrowed against. Next slide will show that luckily the parameters are not that strict, and you can borrow against stocks, which is the most common, as well as mutual funds, GICs, HISAs, and many more. And you'll see the loan table with the maximum loan percentage for each type. Just keep in mind that this is based on the current market value of these investments. So for stocks priced at $5 or more, you can borrow approximately 70%. Stocks from $2 to $5, the loan is 50%. And for stocks trading under $2, which is typically penny stocks, that's a no-go for borrowing against due to its risk and volatility. Moving on, typically trading on margin is suited for those with a higher risk tolerance, have good knowledge of the markets, as well as being financially comfortable from a net assets point of view. It's not a requirement to borrow if you do open a margin account, so it is quite handy to have if you're ever caught in a pinch for funds. Now, to illustrate the differences between investing in a cash versus a margin account, this slide here will show you a couple examples. So in this case, you have two different investors, and both of them have the same idea to buy 1,000 shares at $10 a share. In the case of investor A, if he wants to buy 1,000 shares at $10 each, he'll need cash available of $10,000. Investor B, on the other hand, would only need $3,000 to purchase 1,000 shares at $10 because the security is marginable at 70%, which means the broker is willing to lend you up to 70% of the purchase, or $7,000 in this case. Investor B would only have to put up $3,000 of his or her own money for this transaction, which is the 30% margin required. Now let's say the stock price goes up from $10 to $12 a share. What will happen to investor A and B? Both purchased 1,000 shares at $10 each, except investor A spent $10,000 in his cash account versus investor B, who spent $3,000 to do the same, but in his margin account. Because the share price has now gone up to $12, that gives investor A a return of 20% versus investor B's return of 67%. So as you can see, investor B using leverage in his margin account has magnified his returns way more than investor A. On the flip side, your losses are also magnified using leverage. So the market is unpredictable and sometimes volatile. It won't always be going up, and of course, it can also go down. So with that said, if the stock has now gone down to $8, investor A is looking at a return of negative 20%, and investor B, who was leveraging, is now at negative 67%. So moral of the story is leveraging can exponentially increase both your gains and losses. So let's say a misstep of judgment occurred and you find yourself in a margin call. There are a couple ways to cover. You can either deposit more cash, which is probably the easiest way to settle, or you can transfer and deposit shares from elsewhere, or finally, you can sell whatever shares to cover the margin call. Keep in mind that when you are in a margin call, it is expected for you to resolve it as soon as possible. So not tomorrow, not next week, but as soon as possible. So be sure to leave yourself some buffer to avoid this happening, which is it's typically the 30% concentration adjustment. Now, why would someone decide to do margin trading? There are a couple advantages in doing so, and the first one being you can leverage in a margin account, and it can give you more exposure to the market by borrowing against your own investments. It also allows you quite a bit of flexibility as it does bear some similarities to a line of credit, access to funds at all times, no obligation to use it. And what a lot of people tend to forget is that you don't have to borrow on margin for the sole purpose of investing. You can use it as an emergency fund, as an RSP loan, to buy a car. Possibilities are endless. And finally, the next slide will show you what it looks like in your margin account. So notice that although you have a negative cash balance of about 12 grand, you still have a positive buying power, which also takes into account your Canadian margin positions. And you can see a more detailed look just by clicking the link below buying power. Now, a bit about our commission structure. So first, we don't charge any commissions for buying and selling all Canadian and US ETFs. It could be iShares, BMO ETFs, whichever ETFs, it's zero commissions. And to take advantage of that, make sure that each time you buy or sell the ETF, that it is 100 shares or more. Place your trade online. And finally, make sure all of your documents are set for electronic delivery. And that's pretty much all you need to do to not pay any commissions on ETF trading. And if you haven't heard of us until today, then you probably haven't heard about our low commissions in general. And we do have something for everyone. So let's say you're already a National Bank client, then you can trade at $6.95. Maybe you're under 30 years old, then you can trade for free, and then the $4.95 afterwards if you go over the 10 free trades that we give you. Or maybe you're an active investor and you do more than 100 trades a quarter. Then luckily for you, you only have to pay 95 cents a trade. However, we do have a special promotion that is exclusive to all those that attend Larry's webinars this season. So for new clients that open an account from now until the end of the year, you will get 200 free trades to use for the first year. So those free trades include stock trades, ETF, options. So it's very suitable for all types of investors. And the conditions are, again, very simple. You should be a new client to us. Enter the promo code during the account opening, place your trades online, of course, and make sure that all of your documents are set to e-delivery, and that's it. Last but not least, we have some short useful videos on our YouTube channel in case you wanted to view more about our trading platform and the navigation around it. And if you have any other questions about our offering, my colleagues at the call center will be more than happy to assist you, or you can also reach out to us directly by email. Thank you again for everyone for tuning in tonight. And Jared, I will pass the torch back to you.
Thanks very much, Anne. So many exciting ways for the self-directed investors in our audience to get engaged with markets. Thanks very much. Well, folks, BMO continues to lead the Canadian ETF industry, not just in sales, but also with innovation. They offer an ever-increasing array of ETF tools to help grow your portfolio, and we're very grateful for the partnership we've had with them since 2009 in investor education. They were the original and premier sponsor of Investor's Guide to Thriving, and like all good partnerships, this one has certainly paid dividends for all concerned. Well, speaking of dividends, live from our nation's capital, with ideas for your capital, is Drew Burgess, Vice President with BMO ETFs.
Excellent. Thank you very much, Jared, for the warm introduction. And it's really a pleasure and a privilege to be here with you and your team and on this Insight session, as well as with all of the viewers that are joining us tonight. What we're going to do tonight is cover, as Jared mentioned, dividends and dividend focused ETFs. And at the end of this educational segment, my goal is really to leave you with 3 takeaways. The first is, what is a dividend factor ETF? The second, how do dividend ETFs differ from one another? And the third, how do dividend ETFs fit into an investment portfolio? I was going to dive into just highlighting a little bit around the BMO ETFs team, and our innovation really has been top of the industry over the past 10 years. We are almost $70 billion in assets under management in a short 10-year window, and really offer a flexible suite of ETFs with over 110 ETF options. So let's dive right in and talk about the dividend ETF factor. What you're seeing on the slide right here, the use of dividends and dividend ETF strategies has hardly been disrupted through the COVID-19 pandemic. And in fact, what we have seen is that the use of ETFs, traded volume in both fixed income and equity ETFs, turbocharged as a result of the desire for liquid, transparent, targeted exposures and lower cost access to investment markets. So I wanted to start with this visual here for everyone to see and highlight the increased use of ETFs versus other marketable securities like stocks and bonds. Now, why are we going to talk about why are we on the topic of dividends? Well, portfolios on the next slide, portfolios are changing in the way that they're managed and constructed, and dividend ETFs continue to be one of the most common approaches to investing and one of the most popular factors. A few reasons why they remain so popular. One, as Canadian investors, we actually tend to be more conservative than our friends south of the border. Dividend paying companies tend to be more mature and stable companies versus non-dividend paying companies, which tend to be in the early stages of growth. We've actually seen a shift, as many of you may be aware, in the level of yields that fixed income and fixed income ETFs alike have historically been able to provide, with yields being more recently compressed. And the search for yield and income in other segments of the markets continues really to be sought after. And lastly, we see a shift with an aging demographic and a need for income. So as you can see on this slide here, as of August of this year, dividend and income ETF flows represent approximately $15.5 billion, making up approximately 11% of the total Canadian equity ETF market share year to date. Now, moving forward, to continue breaking down why dividend ETFs are so popular, it's really important to understand the trade-offs among some of these other factors. Dividend strategies are focused on total market returns, meaning that in addition to an income stream, there is a potential to capture upside growth too. So the total return potential of dividend strategies benefits both from a yield component as well as a growth component of the underlying securities. As seen here, in contrast to, for example, growth and low volatility strategies, growth-oriented solutions can be more volatile versus dividend strategies. Growth have the potential to capture more upside growth of the underlying securities price appreciation, but won't generate a yield. Low volatility solutions, on the other hand, are designed really to have lower market risks, are more focused on risk mitigation, I guess I should say, and can generate a yield, but yield really is not the focus in low volatility. Market risk is. So to continue moving forward and building off on the trade-offs, we can see here a few examples of the yield trade-offs across 3 different Canadian equity ETFs. ZCN, which is the Canadian TSX Composite, the broad market. This is a market cap weighted index, which may offer more capital growth opportunity, but comes with potentially more volatility and a lower yield versus dividend strategies. ZDV in the middle, the BMO Canadian Dividend ETF, offers the highest yield out of these 3 and focuses again on total market return with defensive growth. And lastly, ZLB, the Canadian Low Volatility ETF, focuses again on more risk efficient exposure to the markets with defensive growth characteristics, but not necessarily focused on, not focused broadly on companies paying dividends. So depending on your needs, there will always be some kind of a trade-off. As we look at the differences in how ETFs capture dividends across the full market spectrum, it's important to know what's under the hood when looking at the dividend yields that are being generated. And more importantly, what types of dividends are being generated? And are these dividends likely to be sustainable? Because all dividend income is not the same. So what we see here is yields broken down based on the types of dividends that are generated in the markets and contrasted with annualized volatility. There are companies who are bucketed based on whether they are dividend growers, dividend payers, which are companies that would have flat dividend growth, and dividend cutters. And what we see is lower annualized volatility comes as a result of being able to screen for dividend growers and dividend payers versus those dividend cutters. On the next two slides, what I've done is I've highlighted a number of Canadian dividend ETFs and US dividend ETFs, because again, there is not just a one size fits all. As we have just learned more on the fact that all dividends generated are not the same, so too is the fact that all dividend ETFs are not constructed the same. So I'm going to try to break this down, into three parts. We see a number of variables across different ETF providers, and I want to just focus in on three of them for this session. The first, the weighting methodologies. So on here you can see that the weighting methodologies can be either yield or market cap weighted. Yield weighted, which BMO follows, gives a higher weight in the portfolios to higher dividend paying securities versus market cap weighted, which is weighted by a company's total market capitalization, essentially their size, and doesn't directly factor in individual securities' level of yield when weighting in an ETF. Screening process, this varies across all five of these examples and should really be looked at more closely, as some of these strategies may encompass more or less of those dividend growers, dividend payers, and dividend cutters that we saw in the previous slide. And in turn, what will happen, it will result in different levels of yield and growth. The last difference I'd like to point out on this slide is sector exposures. ETFs really do continue to add another layer of transparency to be able to complement portfolios based on an investor's needs. And not all investors have the same needs and wants, as we all know. Differences in the desire to increase or decrease sector exposure while also adding a layer of or a level of yield in a portfolio can be achieved by really knowing what's inside of an ETF. Here's a quick look on the next slide. Here's a quick look at a few of the US dividend ETFs, thank you. As mentioned, these different approaches to navigating dividend markets and dividend paying companies results in different baskets of securities with different levels of yield. And again, it's not a one size fits all tool. As we can see here, all four of these US dividend ETFs pay a yield, but what I will point out is the range of yield is quite wide, from 1.29% to 3.84%. So there's something different happening in terms of the methodologies that each of these four ETFs uses under the hood. And when we chart out on the next slide the trajectory of some of these different factors, here I've put a dividend appreciation ETF, a high quality ETF, a dividend ETF, and a quality dividend ETF. They all sound very similar. But what we see is that each performs differently as a result, again, of the way that the ETF is constructed and its factor approach, what is under the hood in the ETF. And again, not all ETFs are the same, just as all quality factor ETFs are not the same either. And this is a really important point to note to keep in mind. Moving forward, I wanted to take it one step further and really just highlight a more detailed example of BMO's dividend screening process, just as an illustration, and to give an example of the depth of analysis a dividend ETF goes to when selecting securities to include. So with our screening process at BMO, we start with the broad market, that could be the Canadian market, the US, or the international, and we narrow down by screening for companies that have a flat or growing dividend over a 3-year period. And then we look at the sustainability of that yield going forward over a 5-year period. And lastly, we weight, as I previously mentioned, by yield. The highest yielding securities have the highest weight, and the lowest yielding securities have the lowest weight in the ETF. And the goal, essentially, at the end of the day, is really to find consistent and reliable high dividend paying companies. The importance of this process I just highlighted on the last slide in selecting high quality mature dividend paying companies is an important one to better understand the yield that is being paid out to the investor and likely tax exposures as well. It's important to know One, if the product is generating enough income to pay the distributions, and secondly, is the stated distribution yield current or backwards looking? And what this means is if the distribution yield is higher than the underlying yield of the dividends being generated, this can result in the NAV, the net asset value of your holdings, to decrease, and a portion of that yield actually being paid back to you in the form of return of capital. I have two more quick slides that I'm going to just finish off on, and I thought it was important to include a simple illustration of a portfolio scenario where you're actually able to bring together a few different dividend ETFs into a portfolio to customize geographical exposures while at the same time increasing yield to include dividend ETFs. And what is also interesting to note is, and what we have seen over the past number of years, is a growing trend in using one-ticket dividend portfolios, such as the tactical dividend ETF fund that Larry Berman manages at BMO. And this solution that Larry manages really just simplifies the dividend investment decision process by investing in a portfolio of ETFs that focuses on managing both market risk, which we've discussed a bit today, as well as yield, and does so tactically depending on the market environment. If you'd like to know more about the tactical dividend ETF fund, do not hesitate to give me to contact me following this presentation. And on the last slide, I'll end off here briefly just touching on tax benefits in investing in Canadian dividend securities and ETFs with the tax credit, as well accessing international dividend paying companies, which can actually be more tax efficient through an ETF versus investing directly in the underlying companies. So this is really just one more layer to consider, but a very important one. And we break down and provide detailed outlines of our tax parameters on our public website for you to be able to understand more around where the income is being generated in a given strategy or an ETF that we offer. That can be found at www.bmoetfs.ca. I encourage you to browse around. But taxation on all investments is very important and something we need to be mindful of, again, because as I highlighted through this presentation, not all dividend paying strategies are the same. And with a look under the hood, we can actually really narrow down what we are trying to accomplish with an ETF and pick the right ones for our own individual investment portfolios. And with that and time in mind, I will shift gears here. We have the co-founder of ETF Capital Management, very well known for his time spent on BNN, the BERMAN'S call. His extensive depth of knowledge and technical and fundamental analysis spans back over 30 years of experience in the investment business. And with that, I'm going to hand the stage off to Larry Berman.
Well, thanks very much, Drew and Ann. That's great. We really appreciate your sponsorship and education efforts along with ours every week here in our New World virtual roadshows. I'm kind of liking this, although I do miss the interaction with people. I don't miss getting on airplanes and winging around the country, I have to say that. Tonight, I want to talk a little bit about the Fed put and the moral hazard around what's driving markets these days. We saw an announcement a few hours ago where Steve Mnuchin said, the Treasury Secretary in the States said, any unused room on these things that all these programs of support from the Fed should be given back to the Treasury. And right away, futures markets started not like that. The market is responded in a positive way because it believes that stimulus and debt monetization from the Fed is going to be a big factor. So I want to focus on that a little bit tonight, and very specifically why I don't think rates can go up. There's a lot of people now calling for an inflation cycle and a bond bear market, and I don't think rates can rise in a material way. I want to talk a little bit about the Financial Conditions Index. I came across a very interesting study this week, and I want to share some info with you on that. And then there's this whole narrative around, well, all the good news is out now. The vaccine is imminent, and maybe we now sell the news. So those are all the things, and then leave lots of time for Q&A tonight. So interest rate sensitivity is now probably the biggest risk that all markets face. And what I'm showing here on the the, the left side of the graphic, going back to 2003, is what I featured this week on BNN on my show, and I expanded this. But I had seen this study earlier or late last week, and I thought, well, this would be something to talk about on the show. I want to expand on a little bit here because going back 20 years or so, when you look at the cumulative growth in earnings per share, you can see that in the stock 600, which is the European equivalent of the S&P 500, so pan-Europe, German, France, Italy, Spain, UK, the pan-European stock market has actually had no earnings growth for the better part of 20 years. And when we look at the US market, the green line, S&P 500, you know, from 2003 to the bottom in 09, there was no growth, and then we've recovered. So we've had earnings growth to the tune from the 2009 trough of about 150%. But the blue line is the NASDAQ 100. And if we were to take the growth in earnings from largely these big tech companies, and we all know who they are, and take that away from the S&P 500, the stark reality of the world, folks, is that there's been virtually no earnings growth anywhere. And if you think that's bullish, we've got a debate to be had, because it isn't bullish, but it is the market we live in. And in the world we live in, so this graphic on the right side now, blown up, what you can see on the right side of that graphic in the blue line, falling blue line, is the interest rate. And as through the crisis this year, you can see how it collapsed. What you have on the right side is the value of the NASDAQ. And the thought process is, with liquidity being provided by central banks and the low rates, this benefits growth companies, not value, not banks, you know, the traditional value name. And so growth has outperformed value in a huge way. I've talked about this over recent weeks. I've shown it differently. But what this tells us is the sensitivity of the world and the investment markets, and what's been driving them is all about low interest rates. So I came across a study that two different places, but I've put a link to the research paper, and you can go read the paper if you like. And then there was an article that appeared in Barron's to talk about the Fed put. And it was a combination of both these things. And what we saw, I saw this week, I was on a conference webinar that State Street put out, and they had Professor Schiller talk. And he's come out with a recent study where they've gone back and they've looked at the market narrative, and they've proven that since Greenspan took over the Fed in '87, the language at the central bank through their transcripts, so their meeting and their meeting minutes, has a direct correlation with what they call financial conditions, but basically what the stock market is doing. And so every time the stock market has some volatility, they use the term financial conditions. They don't say we're cutting rates to support the stock market. They say financial conditions are such, and therefore jobs are at risk, and therefore we need to act, and so forth. So the degree of language in the different Fed leaderships over the years has elevated around this whole idea of financial conditions. So what is the financial conditions index? So basically, over the past 25 years, since again Greenspan took over, and they really started to focus on financial markets, you have credit and you have liquidity. So the money markets, the TED spread is the difference between the euro dollar funding rate and T-bills. So that's one funding mechanism. LIBOR and the overnight interest rate swap spread, LIBOR OIS, that's another funding mechanism. And then for corporates, it's the commercial paper rate over the government T-bill rate. So those are all money market instruments that are functions of the clearing markets, the money markets, the import, where 90% of the day-to-day cash flow and lending happen. Then there's the longer term credit markets between what a government issues debt at and what a high quality or low quality corporate would issue debt at. So you have the credit spreads, so high yield relative to governments, municipals relative to governments, high quality credit relative to governments. And then you have the swap market that's linked to credit. And then you have the S&P 500 and its volatility. That is what makes up financial conditions. And these are all coincident indicators, meaning there's no leading indicator here. The Fed will not be active if financial conditions are tight, meaning this index has got a positive reading. But as soon as this index goes negative, that's when the Fed starts talking about helping out. And the moral hazard now is that there's this Fed put, right? And that, don't worry, we know. And financial players, corporations, they've gone out and borrowed cheap money. They're buying back shares. There's a tremendous amount of risk in the system that's been completely papered over by all these support programs. There was an article in the Wall Street Journal yesterday. Recipients of PPP loans filed for bankruptcy. So if you look at the Russell 3000, so the S&P 500, S&P 400 mid cap, small cap 600, the Russell 2000, those indexes make up the 3,000 top stocks. 20% of those companies, approximately 527 of them, do not generate enough cash to pay their debt. Forget about anything else. They can't pay unless they borrow money to pay. This is what low interest rates have done. And in the past year, really since COVID, they've collectively added about $1 trillion, not about $800 billion in extra debt. So the Fed has instituted all these programs. They had to. They didn't really have a choice, right? Given the world shut down so rapidly earlier in the year. But folks, all this is papered over. There's no quality here. Again, I keep pulling my hair out when I hear strategists say, oh, market's good, we're good. The only reason, folks, we are good is this Fed put. And, you know, so the next, to me, the next big risk for the markets is a policy mistake. And so is it going to be a mistake for Mnuchin to pull back all that money? You know, if they don't do enough stimulus, is this going to be a policy mistake that the Fed would ultimately monetize? This is what I'm worried about, not so much for the next 6 months because we're going to get a stimulus package, but it's going to be a lot less than what the market wanted and hoped for, and we'll see how that all plays out. But I think the back half of next year, once the next big stimulus is done, I don't think that Congress, and specifically the Senate, has the appetite for continuing to strap on the debt. And I fear that the conservative, fiscal conservative part of Congress may make a mistake here. Now, the Fed is all in. They said, give us all the debt you want to create to stimulate and get us through COVID, and we'll basically buy it all. That's the unwritten kind of rule that Powell has put out there. So make no mistake, it's creating zombie companies. It's creating all kinds of bad corporate actors that are borrowing money because money's free. You've actually heard Trudeau say, and I think Morneau said it too before Trudeau fired him, that we can borrow now cheaply, and so it doesn't matter how much we spend because the cost of the debt today is cheaper than it was when Harper was in charge. Why? Because interest rates are lower. So it's these lower rates that are really screwing with people's retirement. And it's created this bubble, right? This is an interesting graphic that I saw this week that was put out, and it looks at the basket of stocks that Goldman Sachs, and I talked about this a few weeks ago, calling the economy's closing beneficiaries versus the economy's reopening. And so when the vaccine news hit, a week and a bit ago now for Pfizer, you saw the reopening stocks rally huge and the closing stocks started to sell off. So we've got this rotation coming out of the growth and going into the value, and interest rates started to tick up, gold started to sell off. They're all linked, everything's linked, and it's all linked to interest rates, right? And this idea of central bank support. And that's what's keeping the party going. And now I get asked a lot, how long is this going to last? And the answer is indefinitely until they make a policy mistake. And when they make a policy mistake, financial conditions, i.e. the stock market and credit spreads, will blow out, and the Fed will come to the rescue with more QE and buying bonds and forcing interest rates lower. So interest rates can't go up again. Now, this chart shows two ETFs for the S&P 500. So you're all familiar with the spider, the SPY. This is the SPY growth index versus the SPY value index. I featured these a few weeks ago on these seminars. And what we're now seeing, starting with the election, is a rotation coming out of these growthier names into more of the value names. And you can see that in the relationship between growth and value. So when that yellow line at the bottom starts to go down, which it did once we got the vaccine news a couple weeks ago, that the value stocks started to outperform the growth stocks. And the big question is this a trade or is this a theme that's going to be with us for a long time? Because we know these growth stocks are very, very expensive fundamentally. I use the example of Apple. Apple for 30 years traded at 20 times earnings on average. It's now trading at 30 times earnings. So what makes Apple worth 50% more this year than it was for the last 30? And the answer is nothing, right? The answer is nothing but liquidity, and everything that wasn't working shut down, and the money went into everything that was still working, people's phones and whatever. So at some point, that premium is going to come out of growth and go back into value, like we saw when the dot-com bubble burst. But we really need the economies to open up again, and that I'm not clear on. There's going to be a vaccine. How many people take it? The efficacy numbers are great. I'm very excited about that. and will normalize, but it's going to take a lot longer than the market's expecting. And the bigger risk, the higher we go, is that policy mistake. Because if interest rates start to tick up, financial conditions start to weaken, that's when the stock market is risk. So the stock market is only here because the Fed is printing money and keeping interest rates artificially low. That's what it's all about now. So we have to watch interest rates very, very carefully. But going back to this this slide here, and what I've shown every week now, is that your typical retirement portfolio, that 60% stocks and 40% bonds, has a guaranteed, not guaranteed, but a dividend plus interest rate yield that's never been lower. And that presents the big problem for investors, because I've put out this list of stuff that I like, and it's all crazy expensive. There isn't anything on this list that isn't over the top crazy expensive in terms of, but the money is going into this stuff because it's working. And I would caution that when the money goes in, starts going back into the real economy stocks, that a lot of this stuff comes unglued. And that's going to be part of the next year or two of markets. So some caution on that, folks, is the message this week, rather than saying, hey, here's something you need to buy today, because I think there's a lot of challenges in front of us. But as long as the Fed prints money, and as long as they're committed to keep interest rates low, which they are, then the stock market can keep responding. But again, this is not bullish. This is just liquidity. And that's really important to understand. So tonight I'm going to go for the online questions first before we get into the people that had emailed questions in. Jared mentioned at the top, again, if you want to follow us on the YouTube channel, this is going to be the portal for all our educational material going forward. So for the Q&A part, first question that came in tonight, John always comes in very early to get his questions in. So John, thanks again. I've seen your name on the board every week. Great that you're a follower. So you say, with 3,000 plus daily U.S. COVID deaths projected, through the end of the year, I believe those are the numbers they're talking about. Are we expecting a double dip recession? And do you think that we're going to retest the March lows? So the answer is no. I do think we're going to get a double recession. The fourth quarter is at risk with lack of stimulus, that we now start tracking a negative GDP for the fourth quarter, and possibly into the first half of Q1, because it's probably not going to be until sometime in February that they agree and negotiate a stimulus package. This is good. This is very different than what you're going to hear about in December, which is a continuing resolution stopgap spending bill that they need to fund federal employee salaries. That budget date, I believe, is the 11th of December, when they're out of money. And so they need to pass a budget resolution, and they will. But that is not the stimulus that is part of the negotiation between Pelosi and McConnell in the Senate and in the Congress. And Biden at this point doesn't have a say. Well, the president is still Trump until January 20th. And I think Trump's going to stay relatively silent. So we'll see. John asked again if I prefer K-Web to AIA. K-Web is China only. AIA is emerging Asia, including China, but it includes Taiwan, includes South Korea. I think there's some Japanese exposure in there as well. So very different exposures. I don't prefer one to the other, but K-Web is Chinese internet, basically. So very different exposures there. There are some overlap for sure, but they're very different, John. So you're asking which is more diversified. Because AIA has more country breadth, it would be technically more diversified. Because there's not just technology in it, it's more diversified. So I hope that answers your question, John, and thank you very much. Adam is asking, am I still buying gold? And the answer is yes, because the reason I want gold and I'm buying gold in the portfolio. Let me see if I can just slide this in here and see if I can share with you my gold chart here. So I've got all these prepared charts. So the real yield versus gold. So the thesis on what drives gold is two things. It's the value of the US dollar vis-a-vis its trading partners, and largely when you talk about the dollar index, you're talking about the US versus Europe. Canada is 9% of the index. So it's primarily, and Japan is 13%. So it's primarily US versus Europe. And so that's the Dixie, the dollar index. So that's a factor. But the biggest factor and the biggest correlation for years now is what the real interest rate is. So the US 10-year minus the rate of inflation relative to the price of gold. And as you can see in the graphic here, I'll blow up the last couple months here. Let me zoom in. You can see that the real yield that peaked when gold peaked. So gold peaked at, you can see there, 2063, when real yields were negative 1.08%. Right now, negative 0.84. So they've come back and gold prices have come off. Right? That is very, very simple. There's the correlation. The thesis on the Fed keeping rates low, inflation pressures over the coming years increasing with less globalization, that is a factor in why real yields are going to stay negative for years to come. Because as soon as they start to tick up, we start to struggle economically. And the Fed needs to do more and more there. It's part of the whole discussion tonight about the moral hazard on what's going on and what's driving markets. So the thesis on gold still holds. Now, Adam, if you believe that this is wrong, then by all means, we've seen the top in gold. But I don't believe it is, and it's still some of the biggest exposure I have in all my portfolios. Another question Lawrence is asking about gold and ZGD as well, down 15%. Well, so if we look at ZGD, so this is the equal weight global gold ETF. And I'm going to look at it on a total return basis on a year to date. So when gold peaked back in July, right here, the average gold stock peaked. And it looks like it's breaking down now. And if you're just a technical trader, you're stopping out now, you're very frustrated. But has the fundamental story changed on why you want to own gold, notwithstanding the current bad price action? It could very well be that there's a leveraged fund out there in trouble and they're being forced to liquidate their gold stocks. That could be why this is going down. That's what all this was about in March. It was leveraged funds being unwound. It didn't change the fundamental thesis on why you should own gold in your portfolio. So Lawrence, I hope that answers your question, and those are some of my thoughts on that area. At one point, Larry was adamant that we could not have a V-shaped recovery. Does he still feel that way? Don is asking. Well, so yes, we're going to get a double dip here, and it's not a V. But there's a difference, and I explained it all completely, between a V in the market and a V in the economy. So the economic recovery is not going to be a V. Now, they've printed a lot of money and they put a lot of stimulus, and it feels like a V. But fundamentally, under the hood, all that credit bubble, it's fundamentally not healthy, okay? But the markets have given us a V. But when we go back and look at all the other recessions historically, the big ones, you get multiple waves of selling, and this time it didn't happen. And the only conclusion I can make is the monumental support by the central banks. Again, fundamentally, it's not bullish. We have a worse quality of earnings. We have a worse credit market than we've ever had historically. But because the central bank is going to support it, it's going to continue until they stop, and then equity markets have a problem again. So that's my view, Don. I still feel that way. On October 26th, your economist friend, Mr. Rosenberg, said the economy in 2021 will not be strong enough to support the value trade. Instead, he prefers the growth trade. Your thoughts, Mark is asking. So Rosie had said recently, I read Rosie's daily research. I think he's the best forensic economist on the planet. He looks under the hood. He understands it. But like me, he looks at risk a lot more than potential returns in the case of when risk factors are high. So he may very well be right. Value is working right now for a trade. There's no doubt about that. We're excited about reopening, and we're excited about yield curve steepening, and we're excited about more demand for oil. And so the oil stocks are coming back, and the banks are coming back. And those are the two biggest sectors in the value trade. And what Rosie's contending is that the economy fundamentally is not strong enough. And I believe that to be true. And I believe that the main reason that markets are reflating is the promise to cover the risk from the Fed. And so Rosie's probably right in that regard, but what does that mean for the trade between value and growth? Right now, money's going to come out of the overvalued growth names and feed into where there's some value. And that probably continues for a while still. So, you know, when Rosie says that, or when I say that, it's got to be within the context of the trade, okay? James is asking, I'm wondering if you could comment and make recommendations on the robotics and automation ETF out there. RBOT in Canada, bots, and so that's one of the sectors that I really like. It's been on my list of things to buy for quite a long time. So let's have a look, and we'll pick out the RBOT here. That'd be the Canadian version. So you can see the Horizons Robotics one. So let's look at that one. And let's look at that on the way I like to look at it, and that is the relationship to risk. So the yellow line at the bottom is the relationship or the performance over the last year measured in percentage. So it's at 100 a year ago compared to the S&P 500. So that yellow line says 123.7163 means it's outperformed the S&P 500 by 23.72% over the last year. So it's a strong outperformer. That's why we like it. But when we look under the hood and we look at value, we can look through the ETF and we can see that the average dividend yield's less than 1%. The average PE is trading at, call it 2.5 times the S&P. And this is a very high risk area, but because it's a growth area and we know we're going, so it's something you want to own because in the long run it's outperforming, but you're paying 60 times earnings for it. So do you want that in your portfolio? Because when you have something that's trading very expensively, is that something you can handle when it starts for a period of time doesn't work? So I want to buy this, and I want to buy it when it pulls back to a better relative value compared to the S&P 500. And that might mean I have to wait longer. Now, with the benefit of hindsight, I blew it. We should have been loading up in March on this ETF. And if you remember what I was talking about at the time, I was talking about another wave lower and that my shopping list would come out with the S&P below 2000. And damn, it didn't get there. So as much as we were warning about risk earlier in the year and we were worried about a massive pullback, I didn't execute certainly on this ETF very well. So there you go. But thanks for that question, James. Hopefully that adds it. I like it. Fundamentally, I like it. But valuation-wise, it's a big concern. Love your webinar series looking at getting into Brookfield Renewables. I love green technology. So if we look at Brookfield Renewables and look at our chart here, again, this is something that it's a niche area. We can actually, if I do a comparison, I can compare this to the ICLN clean energy ETF that I like, that's on my list. Let's get rid of this one. And if we look at that, we can see that ICLN has been a better performer. So this nothing wrong with Brookfield Infrastructure Partners. Brookfield is exceptional manager in whatever they do. But when we go through a risk period, you can see how volatile it is. I mean, this fell from a ratio of 40 and 30 to minus 20, 25. So like a 50% decline. And now it's way up again. So it's a buy on dips, absolutely, both these sectors. And right now, I think we're at risk for some consolidation here. But it's a theme that when you look at a longer term horizon, so let's see if we can look here. Let me go back to daily. And let me look at wow. So Brookfield's knocked it out of the park. And this global clean energy ETF is just starting to go. So I don't know, which one do you want to own? Anyways, food for thought, but I love this sector. Please provide one of the best ETF value in Canada in the Canadian dollar if there's one similar to SPYV in the Canadian dollar. So value ETFs in Canada. So you've got an iShare Canadian Value ETF. basically the iShare and the Morningstar Canadian value for CI. The BMO one, I don't think exists anymore. So if we look at the comparables here, and we compare this relative to the TSX. So the BMO ZCN is the TSX ETF. If we do that, we can see pretty much that value is in line. If we take the CI growth ETF, no, it's the momentum one. It's not the growth. CI momentum. Here's the Canadian momentum. So that's their version of growth. They call it momentum. So again, what you can see here, looking at the different ways to play the Canadian market. You know, the peak here in growth that was up at 1.10% is now equal to value as these things have converged. And I think if we did this, you all know who the biggest momentum stock is in Canada. So as Shopify has peaked out, like a lot of the FANG stocks in the US, you know, it's come off. You don't look at it this way, but that's 50, you know, this was up 200%. So relatively, you know, it's lost 20% from the October high and from the September high. Anyways, that's just a little spin on that. Larry, I know it's difficult to pick bottoms, but do you think airline stocks will go lower? Last week, I talked about this as a reopening play, the JETS ETF. So this is a way to play the global airlines. And when we look at the ETF, you know, you can see that it's breaking out of a base here. And so the question is, you know, does it go and go back to make a new low over the winter months before they start to rebound? So have a look at this. So let's look at the puts. So if this is something you want to own, but you're nervous, if we look at the puts, keep in mind you need a margin account to do this. So if we look at the March puts, it's trading at 21 today. You can buy it at 17. So you can write a 17 put. You can probably get 80. You can get 80 for sure. That's the bid. You can probably get 85, which was the last trade. And so you're getting at $17 value, you're getting a 5% yield waiting to buy this at 17. Now, if it doesn't trade there, okay, you don't get to buy it, but you can take that 80 cents, call it 85, because I think you can get 85. And you could say, okay, what are the March calls trading for? So I can spend 85 cents and I can buy, if it's going to keep going up, it's going to keep going up, right? So I can buy call it a 26 call for 85 cents, right? You can see it there. So let's go back to our chart. So if I sell a 17 put and I buy a 26 call, I either get to buy it at 17, which is down here where it broke out from on the vaccine news, right? That's vaccine news there. Or listen, if it goes back to those lows, that's a different story. I don't think it will. Could it go back to these lows? Sure. Is it going to find a lot of support around this 200-day and where it broke out from? Probably. So, but if it takes off, you're long the call. You've got all the upside if this thing goes back to $30 where it was before COVID. So you've got the potential from 26 up. So I think you need to think creatively about some of these positions and how you would go about, putting them on and so forth. So that's just an idea about the airplane sector there. Okay, I'll take one more online, and Larry, thank you for a great presentation. With Tesla getting into the S&P 500, you know which company is getting kicks out. So we don't know which one will replace in the S&P, but if you look at the Spider ETF, SPY, and you looked at the holdings, and I now flip this around to look at the bottom part of it. News Corp, Under Armour, the Xerox, these are all potential. Fox B, these are all the smallest weights in the index. Marathon Oil, Ralph Lauren. So the index committee will look at some of these that may not qualify to be in the 500, and it would replace that. But that's not the important thing. When Tesla comes in at 400 billion, when you look at what company's 400 billion, you're basically looking at the same size as Visa, JP Morgan, J&J, right? They say it's going to be the 8th biggest company. So in order to make room for the $40 billion approximately that Tesla is going to be bought at, these are the names that are going to shrink. All the other ones that are lower are going to shrink, but very small. The vast majority of that 1% is going to come out of these names because they're the biggest weights, so they're going to lose the most. So what this ETF will have to do is sell enough of Apple, Microsoft, Amazon, Facebook, Google, Berkshire, so that it can buy the equivalent amount. Now it's going to sell some of the other names too, but smaller amounts. So it's the bigger names that are going to be hurt the most when it gets put in the index. And that's why they're talking about doing it slowly in tranches and things like that. Okay. Let me get back into the live Q&A here. So Dave is asking about ZZZD, and he's talking about, I didn't explain the current performance. So essentially he's talking about return of capital and everything else. So I prepared a slide here that looks at ZZZD year to date. I've put my benchmarks. So my benchmarks are 80% global dividends. CYH, tonight Drew talked about dividends. So CYH is the iShare Global Monthly Dividend Index ETF CAD hedge. That is 80% of global dividends. And you can see year to date, the global dividends are down 12. A week ago, or before the COVID announcement, they were down close to 20. So a lot of money has come back into the dividend names. ZDV is the Canadian dividend basket, down about 5 year to date. So my benchmark is down about 12 year to date. We're down 10 at the moment. So I'm not happy about that. Okay, I'm not at all. Now, when gold peaked out in July, my biggest holding is ZGD. Gold pays very little in ways of yield. So I'm holding other things for the yield, but I'm holding gold because I fundamentally believe that this should be a core part of portfolios today for the reasons I've talked about tonight. Not for yield, but for protection and growth. But gold peaked here, and for months, it's been going down. It was up almost 60% year to date. It's now up like 20. This, being my biggest position, is why ZZZD for the last few months has gone down mostly. Okay? It's my biggest position falling significantly. Again, fundamentally, I believe in gold. I talked about that. And my other big position is in ZPay, and I talked about that a lot. We got a lot of questions on ZPay tonight, so let me get to some of those. Okay, thank you for your great work. You're welcome very much, Ron. With the advent of central bank liquidity, can we expect immediate V recoveries from any future equity collapse? Have we eliminated equity risk? So I talked about that, Ron, tonight, in that it's a coincident indicator. We haven't eliminated equity volatility, but the Fed and the government and stimulus and central banks will be reactive to it, not proactive. So again, it wasn't until financial conditions collapsed that all these programs came in and the markets recovered. So yes, we can expect moral hazard. So in that world, Ron, how do you value something? How do you say that stock is worth that much times earnings if everything supporting the market is liquidity? And the answer is you can't use anything traditionally in fundamentals in terms of discounted cash flows because it's all artificial. So we are in a world going forward. And I mean, it's been this way for years, but it's intensifying, that every period of market volatility will see language from the central bank. They'll trot out a speaker. The speaker will say, don't worry, markets, we'll be there for you, and things will stabilize. And that is the world we live in. That doesn't mean you should open a margin account and leverage the farm and buy everything in sight, because there will be policy mistakes. We will go through periods of difficult volatility. So Ron, great question. One of the things that I think about a lot, for sure. I'm interested in gold. I've talked extensively about gold, but there's a bonus question that John is asking. And with the price of gold being so high, it makes the gold silver startup cost seem attractive. The cost of starting up and building infrastructure into a mine in the middle of nowhere where there's no roads, there's no electricity, there's no infrastructure for housing, I don't think it's as attractive as you might think for startup costs. So, but I'm not the expert on that. Are there any ETFs with smaller producers? So the answer to that is yes. BMO has a junior, a ZJG, which is a junior gold miner. And if you look at the volatility of that one, let's look at that on a 5-year daily basis. And then let's compare that with GDXJ, which is the junior for in the States. And there you go, right? It's crazy volatile when I can overlay that with just the gold bullion ETF, so you can see by way of volatility comparison. So when gold bullion ETF went from a ratio of 22 down to 0, so it lost 20%. The gold stocks, the juniors, went from a ratio of 158 down to 48, lost 60%. And that's what you're dealing with the juniors. And you're seeing, as gold comes off 10, 15% from the high, the gold stocks are coming off 30, 40%. So you get the benefit when it's good, and you get the hurt when it's bad. So that's what you're dealing with when you're talking about our juniors, John. So if you're good with that, those are a couple ETFs you might want to have a look at. So Bill actually put a dollar amount in, and I took it out because Bill, even though your last name isn't there, nobody's business how much you have in your retirement portfolio. So Bill has invested a lot of money in ZPay, and I think largely because I've ranted and raved on how wonderful I like it, and that it's a core holding in my portfolios. And he loves, like I do, that it pays a 6% dividend. That dividend is largely coming from some of the stocks. I would say 1%, 1.5% is real dividend. The other part of that yield is coming off the premiums earned from covered calls and from put rights. So most of the premium is coming off the options, which is actually treated as a capital gain. So people look at of capital and they think it's a return on capital. It's not a return on capital. It's a capital gain distribution. It's a very, very different thing. So you really have to look at that and understand it better. So you want to be able to hold this for a very, very long time and live happily ever after. So that's ultimately the question. So if we look at what ZPay did this year, now it's only been out since about the middle of January. So I'm going to delete these. So we just look at the total return of ZPay and what ZPay did compared to, I'm gonna use the iShare Core Balanced ETF, and then I'm just gonna compare that to VTI, which is the entire, well, I'll do VT, which is the entire world stock market. So just so you see. So it's not without volatility, but when the world went through COVID, ZPay was down 12, 13%-ish at the worst of COVID in March. The balanced ETF 60/40 global portfolio was down 20%-ish versus the world equity market at its worst down 34%. Great question, Bill. And that's what it did through the worst economic hit in the world. So if you're okay with a periodic drawdown of 10, 12, 15% when things are awful, then ZPay is something you can clip that 6% coupon and have a very nice ride. Okay, and that's why I love it so much. So Bill, it's not fixed income, but when markets go down, you get put stocks and you buy them cheaper, and then they write covered calls on them to sell them at higher prices. I just love the strategy. I do that for my clients in our private client portfolios as well. I love that strategy so much. So let me go back to the questions here. Okay, I'm looking for some ETFs to diversify globally and overseas. I'm considering XLI. XLI is US industrials. So if you want global industrials, EXI is going to give you global industrials. And then you mentioned Korea, EWY. So now EWY is a huge play on Samsung. I think it's 20% of Samsung and Hyundai are 20% of 25% collectively of Korea. So when you look at those and how they've performed, you can see the US, Korea's done the best. EXI Global and XLI US, very, very similar, year to date. So that's actually, let me go year to date there. That was the ZPay date there. Again, you can see what they've done there. So those are a couple things. But if you're looking at global, I wouldn't just do EWI. I mean, a broader emerging market EEM is probably one of the broadest ones you can buy. You know, it's hasn't done as well as South Korea, but you know, that would be a way to play broader emerging markets. I like Thailand. I like Indonesia. I think they have some good fundamentals and don't have quite the debt problems that some other countries have, and so forth. I like Chinese A shares. You can look at a KBA, for example, a Chinese A share market, and so forth. A lot of different ways to play globally, Kara. Joanne says, with Tesla joining the S&P, we'll sell. So I talked about this already. So that question came in. It may have been Joanne who asked that. I'm not sure. So we got that one. We did that one already. For 2021, what countries and sectors do you forecast to perform the best based on risk-adjusted returns? Paul's asking. So I mentioned a couple of them. So let me throw a few in here. So EIDO, iShare Indonesia. I do like South Korea, EWY. I do like Japan. DXJ is how I would play that. I like Thailand. I like India. So these are some of the ones that that I would look at for international, Paul. Okay, Mark, is ZTS, is this a good place to park some money for a while and take advantage of the Canadian dollar returning? So this is like a short-term corporate, so ZTS Canada, short-term US Treasury bond. And the other way to play is DLR. So that's like playing the US dollar as a Canadian. So here's the difference. Let me get rid of these. The difference between these is that DLR doesn't pay much of a yield, but the play here is the US dollar, right? So FXC, so this is the US dollar ETF. So, and it trades in the US, so it does the inverse of those. So you can see that those two are, but the difference between holding the BMO one is that you get a yield off that one, right? So ZTS has a price change of 350 and a total return of 480, where DLR simply has a price return, okay? They're both plays on the US dollar. ZTS is a very good way to do it. But you can see you're playing the US dollar. You get a bit of a yield there, yield pickup, maybe 1.5% or so. So that's a good holding, yes, if you want to store some US cash or if you want to play the US dollar, Mark. Another question on ZPay, is there a practical limit to how someone can purchase this? I wanted to buy 100,000 of it. I found that I exceeded the amount available. So I'm not, the liquidity on ZPay is more than adequate to handle $100,000. If we bring up ZPay, again, oh, that's the US dollar version. Let me bring the Canadian dollar version up. And let me just bring up the value, the traded, get the volume in here. So if you look at the daily volume, it doesn't trade a lot. It's 56,000 shares a day. And the value, and then so you multiply that by that, and you see roughly 1.5 million trades every way. So today, 400,000 traded. So I'm not sure you could buy 100,000 no problem. I think what you should do is put in a limit order. So if you go in your online account, let's say you're using National Bank, and you see the market is 82 bid, 86 offered, go in the middle, put a 30/84 limit for the size that you want. So if you're buying 100,000 worth, you're buying 3,000 shares. Check me on my math there. I believe you should have no problem at all trading that. If you want to put $100,000 in, right? So it'd be 3,300 shares approximately. Should have no problem, and put a limit order in. You don't need to pay 86. Now, if it gets away on you, you got to be patient. But go mid-market, put a limit in, and you'll probably get filled on easily for 100,000. I don't see any reason why you wouldn't have got filled there. Anyways, folks, it's 8:30. Thank you so much for your time tonight. Please consider supporting one of our charities. Sorry I didn't get to all the emailed questions. We will try to get to them next week. If you're interested in the funds we run for BMO, go to ZZZ Portfolios. There's weekly updates we post on all the holdings, what we're doing, our thoughts there. I'm all about open communications with clients and people who use our strategies. If you are interested in a customized portfolio review for you, please see us at etfcm.com. There will be a link in the email about that. Independent, fee-based financial planning, YouPotential. Monique is the best. You'll love dealing with her. And for the women out there, Golden Girl Finance. And if you are a financial advisor and want to learn how to work closer with me and what we do, please check out Q Wealth. Have a great week, everyone. Stay safe, and we'll see you next week.